Welcome back to the COO's office. In our last session, we looked at the world through a telescope. We used the top-down approach to find the wind and the bottom-up approach to find the ship. You have identified a company that looks promising. The product is cool. The CEO is charismatic. The industry is booming. You are tempted to buy or reaching for the buy button. Stop. Put your hand down. As the Chief Operating Officer of U Inc., you cannot make decisions based on vibes. You cannot invest based on a feeling. You need hard evidence. You need to look under the hood. If you were buying a used car, would you just look at the shiny paint and say, "I'll take it"? No. You would check the engine. You would check the mileage. You would check for oil leaks. In the stock market, looking at the engine means reading the financial statements. Today, we are going to learn a new language. It is the language of business, accounting. We are going to discuss reading financial statements, analyzing corporate report cards. Do not be scared. We are not going to become accountants. We are not going to balance the books. We are simply going to learn how to read the three most important documents in the business world: the income statement, the balance sheet, and the cash flow statement. Think of these three documents as the medical records of a patient. Document number 1, the income statement, the movie. This document tells the story of what happened over a period of time, usually a quarter or a year. It answers the question, is this company profitable? It starts at the top with revenue. This is the raw money coming in from sales. It ends at the bottom with net income. This is what is left after paying for materials, labor, rent, interest, and taxes. Many amateur investors only look at revenue. They see sales are up 50% and they get excited. But the coup looks at the bottom line. If revenue is up 50%, but expenses are up 80%, the company is actually dying. They are selling dollar bills for 90 cents. That is not a business. That is a charity. You want to see a company where revenue is growing, but net income is growing even faster. That proves the company has pricing power and efficiency. Document number 2, the balance sheet, the snapshot. While the income statement is a movie covering a year, the balance sheet is a photograph taken at a single moment in time, usually midnight on December 31st. It answers the question, how wealthy is this company right now? It has a simple equation: assets equals liabilities plus equity. Assets are what you own: cash, factories, inventory. Liabilities are what you owe: debt, unpaid bills. Equity is what is left for the shareholders. The coup looks at the balance sheet to check for stability. We look at the cash pile. Is it growing? We look at the debt pile. Is it manageable? If a company has a beautiful income statement, lots of profit, but a terrible balance sheet, massive debt due next month, and no cash, that company is a ticking time bomb. It could go bankrupt tomorrow, despite being profitable. Document number 3, the cash flow statement, the truth. This is the favorite document of every smart investor. Why? Because revenue can be manipulated. Profit can be massaged by clever accountants. But cash is hard to fake. Cash is either in the bank or it isn't. The cash flow statement tracks the actual movement of hard currency in and out of the company. We focus specifically on operating cash flow. This is the cash generated from the core business: selling burgers, selling software, selling cars. Here is the most common trap for beginners. A company reports huge net income on the income statement. It looks great. But when you look at the cash flow statement, the operating cash flow is negative. How is this possible? Maybe they sold products on credit but haven't collected the money yet. Maybe they have a warehouse full of unsold inventory that they count as an asset. This is a warning sign. It is called profit without cash. It is a major red flag. The coup wants to see a company that is a cash cow. We want to see operating cash flow that is consistently positive and growing alongside net income. So, how do we put this all together? Imagine you are looking at a potential investment. First, open the income statement. Are sales growing? Is the profit margin expanding? If yes, good. The engine is running. Second, open the balance sheet. Do they have more cash than debt? If a recession hits tomorrow, can they survive? If yes, good. The chassis is strong. Third, open the cash flow statement. Is the cash actually hitting the bank account? Are they funding their growth with their own cash, or are they constantly borrowing money? If they are generating their own cash, excellent. The fuel tank is full. If a company passes all 3 tests, you have found a healthy business. You have found a company that is not just a hype machine, but a profit machine. However, there is still one problem. Just because a company is healthy doesn't mean you should buy it. A Ferrari is a healthy car. It is a great machine. But if the dealer asks you to pay $10 million for it, it is a terrible investment. Price matters. How do we know if the price is right? How do we know if a stock is cheap or expensive? We need a way to compare the price to the performance. We need valuation ratios. In the next episode, we are going to master the essential tools of valuation. We will discuss PER, PBR, and LYU. We will learn how to calculate exactly how much you are paying for every dollar of profit and how to spot a bargain in a crowded market. The engine looks good. Now let's check the price tag. I'll see you in the next video.